I know that goes.
All right, welcome everybody to the 331 edition of the Beyond Wall Street podcast. I'm your host, Nathan Bowers, here with Brandon Nieves, the self-proclaimed expert and aficionado. And we're going to finish up last week's discussion. We were kind of on the tail end of showing everybody, hey, how does a MPI tax-free investment vehicle work in the distribution phase, since we covered pretty heavily the distribution phase last week. So we're going to lead in here with a couple key retirement risks, and then we're going to cut right into finishing that illustration we had going last week. So without further ado, Brandon, I'll let you take the reins here and do what you do best. All right.
Okay. Well, I think it's really important to, establish a foundation first, because, when we're talking about the three phases of wealth building, there's the accumulation phase, the distribution phase, and ultimately there's the legacy phase, right? So, it used to be conventional financial wisdom was always about bringing taxes into the future, because it was assumed that you'll be in a lower tax bracket when you get into retirement. So it made sense to defer. So you defer now, pay the lower tax later. The other thing was maximize your 401k IRA contributions. So that is also because, if you're getting a matching contribution, your money, you're getting a deduction on your contribution, your money's grown tax deferred. So, you got a lot of tax advantages along with that. But the other aspect that you have to consider is the risks that are associated to building up an account value large enough so that you can withdraw an income stream from it. Because the other aspect of it is put your money in the market to get the best returns, okay? The problem with that, if you look at the last 86 years, we've had 66 positive returns in the market in the S&P 500, total return that includes dividends, with 20 negative years. Now, out of those 66 positive years, 52 of them were double digits. Out of the 20 negative years, 9 were double digits with negative years. So it just shows you the market's always going to be higher than it's going to be lower. And that's good. But the thing is, in what time horizon are you referring to? Because it all depends on the time horizon of when you're in the market and when you're out of the market. So you can say, yes, overall, the actual return was over 10%. Well, yeah, that's true. But that's in a time horizon of 86 years. What time horizon are we looking at? And what time horizon are you going to get out? And when you start taking a distribution, all it takes is 4 negative years in a 10-year period, or even 3, to change the entire outcome. So let's address some of these risks. The first one is really the most.
It could even take 1, depending how bad it is, like
exactly.
in 08.
Yeah, exactly. And I remember that in 08. I literally remember what happened. And a lot of people that have money in retirement accounts that were invested in equities, they lost more than half of their retirement account. And there are people that, they had the time horizon to recover. Right. But again, everyone's time horizon is different. So there's a lot of variables that have to fall into place in order for this idea of putting money into the market, deferring taxes into the future. There's a few outcomes that have to happen positively in your favor for this to work out. The first thing you got to plan for is longevity. Do you have investments that can guarantee an income for as long as you live? Because if you don't, you might not run out of money before you run out of time. And
that's one of our key questions we always say to ask is, and you have to be proactive. You have to know that, or else you're going in blind. Like, how do you make a plan if you don't know what you want, or you haven't made the plan around those defined terms on this is where I want to be when that day comes.
Exactly. And the other thing too, if you don't have a plan, you end up defaulting into an income strategy known as a systematic withdrawal approach. And that's when you gotta pick out a percentage, and you have to stick to that percentage, and you got to be willing to change that percentage. You got to be willing to live on less income one year, or you got to be willing to, just take a loss from your account. Because what happens is, if your money's in the market when you're taking an income stream, you got to withdraw at least, or they call it the 4% rule. It's not really a rule. It's more of like a suggestion. Now they're saying it's a 3% rule.
Right.
So 3% of $1 million account's $30,000 a year, but then you got to pay taxes on the $30,000, and you're looking at about maybe only 22,000 or 19,000 that you're actually going to net. So imagine, but that's with $1 million. And you have to be willing to do that because you got to take into account the deviations that you're going to have in the market, and you got to take into account the taxes, and you got to take into account inflation. So if you live a long time, taxes, market risk, and inflation are going to be more amplified risks because you're living longer. So plan for a long life, or plan for your beneficiaries to have a long life. Healthcare expenses. If your plan does not take into account healthcare, you got a major hole in there. Right now, $364,000 is the average amount a couple retiring at age 65 today can expect to spend for healthcare expenses. You got $1 million, 364,000 is already eaten up by that.
Yeah.
So the idea is whatever account you're building, you don't want to have to deplete that account because of some unforeseen, event that came up, such as healthcare. So you want to have a liquid pool of money to have an answer to that. If you're using your retirement income, now you're definitely going to run out of money, because now you got to take out taxes. Now you got to think about market deviations, and now you got to think about healthcare. So traditional planning today with these accounts are not responding favorably to that type of risk. You got to understand public policy. Know what's going on in the environment. Do you think taxes are going to be higher in the future? Every time I ask that question, most people say, yeah. Okay, so then why are you deferring? What do you mean? And why are you deferring taxes into the future? I mean, if you're saying taxes are going to be higher, do you know what you're saying? You're saying that I'd rather get a deduction on the small amount of money that I'm investing now to pay the much higher taxes on my total account value. Because remember, you're going to pay taxes on your contribution. You're getting a postponement of it. You're getting a little tax break, but you're going to pay it all back. The government is just not giving this tax incentive to you. So you got to know what's going on and what environment we are in right now when it comes to taxation. Most likely, I would say plan to be in the same tax bracket that you're in now, if not higher.
More. Yeah.
Exactly. But at least plan the same. Don't plan, because if you're wrong and you end up in a low tax bracket, it's not going to really hurt you much. But if you go the other route and defer and you're wrong there, now let me tell you something. The difference between an old man and an elderly gentleman is cash. An old man can't afford to be broke.
Yep.
A young man can, because he's got time on his side. But an older person, you don't have the luxury of being broke. So the other, consider your purchasing power, inflation. If you don't have a hedge against market losses, if you don't have a hedge against tax risk, then inflation is going to wipe out the rest. And there's nothing else to say about that. Inflation will just wipe you out. Imagine market goes down. So now we were making 20 grand a year from your income. Now you're reduced to 15 grand a year. Now you still got to pay the taxes on the 15 grand. So now you walk away with 10 grand, but then you throw in 3% inflation and you're living on what a $5,000 buys you today, 15, 20 years from now. It's just insane to think in those terms. And this is the trajectory, Nathan, that most people are headed into.
Right.
And I'm talking with large accounts. I did so many simulations. I can't tell you how many I've done with a $2 million account value, a $3 million account value. You got $3 million as a lifestyle that you're accustomed to living. You think your lifestyle is going to cost the same now that that it's going to cost 20 years from now? That's going to cost more to live the way you want to live. So
and they
at least,
also don't,
go ahead.
Just if you look at all the financial forecasts out there, if you're really paying attention to it, you're approaching double-digit inflation, which is insane.
Yeah,
that's like being tough. In a whole higher tax bracket. If you think about it, you're making $50,000 a year. That's like being in the $80,000 to $120,000 tax bracket alone, just because.
That's right.
It's just crazy. And you tell me, and I share with you things that we hear people say, just like you just were saying earlier, I never, what do you mean tax bracket? What do you mean
Right.
inflation? What do you
Yeah.
mean? It's just things people don't think of when you put into consideration when they're, thinking about the future. Like, I'll just shove this money in here and then 40 years I'll retire.
Right.
No.
It doesn't work that way. Doesn't work
No.
that way. Yeah, because I mean, I'll tell you, decumulation is so you have to have a different skill set than accumulation. Accumulation is it's pretty simple. You take dollars, you put them into account, you earn a rate of return on it, you don't pay taxes on the return, the money's able to triple compound. That's pretty simple. And then at least once a year, you rebalance the portfolio, you keep dollar cost averaging, and you apply all those same principles. You watch TV and they're talking about the S&Ps here, the Dow's there, the Nasdaq's. Listen, the bottom line is that what's your goal? The goal is income, you know? And it used to be when you had a pension, you didn't have to worry about any of this stuff. You didn't have to worry about what the Dow Jones was at or the S&P 500. You didn't have to worry about that. You knew I'm getting 2/3 of my salary, period, end of story. Well, guess what? We don't have that. Those days are done. Those days are gone. So now you're going to have to take matters into your own hands. And think about this, Nathan. When it comes to the financial planning sector, it's a relatively new vocation,
Mhm.
especially on the distribution side. Most financial planning is fixated on accumulation, building the accounts up. That's what it's all about.
Let's put
If
it
you're
into
focused
a
on that,
let's put into
you're
a
missing the other.
simplistic term, just for the average person. Think
Yes,
about like
yeah.
buying a car. Your 401ks, buy a muscle car. Yeah, it's going to get you that accumulation really fast. But what do you look for when you're buying a car? Your life situation. Oh, you have kids. Oh, inflation. Inflation, attribute that to the cost of gas rising. So what are you going to do? Oh, you get a hybrid. You can plug it in for a little bit to offset the inflation, aka the gas prices. What do you need when you're going to retire? When you're young, when you're young, you want the muscle car. But when you
Right.
overall plan it out, you get a car with a good engine that can get you where you need to. It's got a little bit of speed in it, but you need that fuel economy. You need the protection of MPI. You need the sustained growth of an MPI where you get those returns and
Right.
tax deferred. So it's all about how you think of it in a full scope. It can't just be one aspect of gaining the money. It has to be, how does this car drive in 40 years when I need it to be the most reliable?
Yeah, that's so true. And you think about to how financial planners when they put together a portfolio, what I've noticed is they'll put you in certain investments, maybe 60% stocks here, 20% bonds over there, so they'll put together a certain model. They'll tell you to rebalance it, and it grows effectively, right? It gets big time growth, and you ask your advisor, how's your advisor doing for you? Well, hey, he's doing great for me. I'm very pleased with my account value. Okay, are you pleased with the income value? They don't have a simulation to show income value. Okay, you built up the account, but now let's see how it looks when you start applying income value to it. We already know what the account value is. Now let's apply income value, and people don't see that. And so we're going to show that to folks. But the other thing too is that when you think about it, what they're planning is backwards when you think about it, because what they do is now when you go into distribution mode, they change your allocation model. Now they position you more in bonds. Now they position you more in fixed investments. Now you're getting lower yields. So in a time in your life when you're really going to need the highest returns to sustain your lifestyle, to make up for market deviations and taxes and inflation, you now got a portfolio with a mixture of, you're lucky if you'll get 4% a year.
They
So it's
love
kind of like
showing
running.
that growth chart.
Yeah,
That's the thing. The
yeah,
first thing, like they always do, is I was looking at her accounts and we were switching it over. Man, they love throwing all those growth charts out there, but they throw the fees and the taxes, the printout all the way in the back. So the focus on, man, this is how much you made, except for you lost $8,000.
right. And most of the time they're showing you average returns instead of actual returns. Look, we're not saying any of this stuff is bad. It's just that this day and age today, you got to have an investment strategy that addresses the financial risks, put a plan together
Right.
that is going to address those risks, and then take an action on it. So right
Go.
now, it's all about risk management now. You
Yep.
got to manage all the risk, and even if you don't do it effectively to the way you'd like, at least you have something. Okay, if taxes go up in the future, I'm protected to a certain degree. That's better than not being protected at all. You got to have tax-free revenue in retirement. I mean, it's insane to like, oh, no, I'm just going to go fully taxable.
Cannot do it.
You know what? If you were living in the late 1970s, then I would say defer your taxes. But you're not living in that environment. So
we don't have that fortune of being able to see the future if that historic run will ever happen again, that period.
And it won't. And the 401k was responsible for creating that basically 20-year bull run, because you had all this new money flooding the markets through mutual funds that were held in 401ks. And then all of a sudden, at the end of 2000 or the end of the 1990s, the tech stock bubble bursted and it changed everything, So these are risks that you have to address here. Then that's why I wanted to take a minute and go over that.
Yeah, let me just let me get a closing point here for everybody, just to really solidify that. If you do not know what your risks are, go into your financial planner through your Works HR and ask them all these questions. Yep. Yeah, I'm projected, $2.5 million. Okay, show me what that looks like when I go to withdraw it. How much I'll be able to withdraw, how long it'll last, all the fees, and that's where you're going to show these risks. And it's not even attributing, like you opened with, the medical costs of being a senior citizen.
Yeah, what do you do about that?
Go ask those questions. You'll see it's not possible to create a long-term sustained plan with a good standard of living without some form of tax-free investment to subsidize the tax deferred. So
that's right. And then obviously the fifth one here, we kind of really hit this one already: investing, the impact of investment risk. The thing is this: if you have more safety measures in your overall portfolio, you can afford to take more risk. I have found that most people are just taking a ton of risk and not even knowing they're taking a ton of risk. Because you and I talked about this. We asked people, what's the money invested in your, I don't know. You don't know.
Why is it invested there?
I don't even look at that thing.
If you don't have an answer why you're invested in something, you should probably talk to somebody.
It's a good idea to just look into it once a year. Hey, let me see how my 401k is doing. Let me just take a glance at it. And I can't tell you how people are just not doing it. So it's just that today, risk management is just so important for people to consider. And there are strategies that exist that actually can actually do this for you. But most people just don't know about it.
The biggest problem the average American has is they have so much comfortability with the 401k. Oh, it's been around forever. My parents were in it. All the employers have it. Why do they, they all have it. If you're comfortable, it's like, yeah, that's what you're supposed to do. You should not be comfortable because, we talked about this the other day when we were looking at, our pages on the website. Ted Benna, the self-profound father of the 401k, says it's a monster. It's a monster. Yeah. Because it's too much deferment of tax to where it drowns itself out too quickly. So
yeah, it was meant to be not more like an appetizer to the main course of pensions, but now an appetizer is now being served as the main course. The 401k it used to be called salary reduction plans. It was designed to reduce your annual salary. Think about that just for a moment. It was called salary reduction plan. It wasn't a retirement plan. The pension was.
It just helps you lower your tax
salary reduction. Yeah. So now the 401k, it was not intended to be what it is. And now everyone's doing it. And it's created a mammoth of an industry. The mutual fund industry has become what it is today because of the 401k.
And
an entire financial planning industry has come about because of the 401k.
You see Dave Ramsey people always put all this trust in Dave Ramsey, but you ask the question, why does Dave Ramsey only push IRA accounts and say you have to, invest, in these accounts? Who signs his checks for his, his book deals? Who endorses him? You got to look behind the guys there and see, Dave's a smart guy. He has great plans for getting out of debt, but he has a motive. There's a reason why he's.
Well, look, here's the bottom line. There's a million different ways to become wealthy. I mean, so a person becomes wealthy, they get rich, and then all of a sudden they write a book, and now, everyone listens to them. Just because a person made a lot of money in something does not necessarily mean that they know where money should be going into to make it more efficient. When you have a lot of money, you can afford to pay a lot more in tax. You can afford to even lose more because you got that new money coming in. But had they implemented some of these strategies, how much more wealth they would keep. There's so much unnecessary wealth that people are losing and not even realizing it, because of the illusion, I still got plenty of money. Just because you got plenty of money doesn't mean the efficiency of how it works. It doesn't matter. What matters is how much of all of this are you actually keeping at the end of the day? I mean, if you can accumulate $500,000, but you got to spend $150,000 to accumulate 500,000, that's not really being efficient.
No.
So
if you're going to do something, do it right.
You're right. And look at it and question it. So let's take a look at something here. We're going to look at.
You get one, basically. I'm sorry, what was that?
No, you go ahead. I was just.
Because of time, time being the currency that's non-refundable, you can't get back. You get one, if you're listening to this podcast, you're in your 18 to 30 year age bracket like myself, because of compounding interest, you get one shot to maximize your potential. So how you go about creating this financial plan is just inherent in the way you do it, because you say you do it the wrong way and you don't figure it out till you're 40, 45, you lost 20 years, 15, 20 years of correct compounding interest to get you where you need to be. Same to go if you're about to reach 5 years till retirement. You got to really figure it out.
That's right.
Which is why you're here to show us this.
Yep. Now this right here, I just want to take a brief moment and show this, because I want to convey to everyone that, listen, when there's a difference between an average return and an actual return, and an average return usually just gives you a ballpark figure, a barometer of all the positive years that you get within a given time frame, and then divided by the time horizon you're looking at. An actual return gives you the actual ups and downs of how that actual account performed. So let's say here you have $500,000. If you can protect yourself from the negative returns, in other words, like when you're investing in stocks, right? We talked about this. You create a stop loss so that you know that if the stock falls below a certain point, you're stopping your loss at that point, and so you won't go below that. With an income play, if you have a stop loss of 0, that means you won't go negative. So let's just take a 4-year look. Let's say in year 1, we have where the market goes down, let's say 40%. All right. Like it did in 2008, right? That's a big one. Well, let's say the following year, the market goes up 50. And let's say the following year, the market goes up 20. And let's just say the following year, the market went down -10. Okay. So here, the average return was 4, but the actual return was -2.80. But you're going to get a response of, oh, but it averaged 4%. Yes, but that's not what you got. The average is 4. The average doesn't mean anything. What means something is the actual. So if you look at this situation here, this is where most people are at. Market goes up, they make money. Market goes down, they lose money. Oh, my advisor did great for me, and I hear that. Oh yeah, we had a 13-year bull run. I hope he did well for you. But the idea is, how well did he do for you when the market goes down? I mean, there is no glory and making money when the tide is going in the same direction.
Right.
I mean, it just doesn't. So what? It's a bull run. We're in a bull market now. When we hit a contraction, we're in the contraction phase. Let's see how your portfolio is doing then. I mean, if you're just, it's up and down, then you don't really have any safety measures here. So this is what you have. But watch what happens if you create, just instead of getting any negatives, we just get zero. If you get zero, you don't even need 100% of the market gain to do better. So what I'm gonna do is I'm just gonna reset this, and I was gonna say, okay, so year one, market goes down. What do we say, 40? Okay, so we get zero. We don't make anything. Market goes up 50. We don't get 50. We get, let's say we get half of that. We get 25. Market goes up 20. We get half of that. And then the market goes down -0. We get zero. How much do we have? $687,500. Your average return was 8.75. Your actual was 37.50. What if you got even less than that? What if you just got 12? Let's say you got a cap of 12%. So now you got $500,000. Market goes down 40. You get zero. Market goes up 50. Let's say you get 12. Market goes up, what do we say, 20? So you get 12 again. Oh, hold on. Market goes up 20. You get 12. And the market goes zero or negative. You get zero. You're still averaging 6%. Your actual is 25.44, and you have 127,200. Think about that for a moment. Let that just sink in, because a lot of people are just, even advisors, oh, that's not true. Now they'll say that's not true. That's impossible. There's no way you could have equity exposure and have your principal protected if the market goes down. Yes, there is. Haven't you guys heard of call options? I don't understand how, I don't know. I don't get how I get to hear those responses. But this is to showing you what an MPI can do. Market protection hedging, or as we say, insurance. But what's another word for insurance? Hedging. So if you get none of the losses, you only need half of the market gain to actually do better than the overall market. Now look at an illustration. If you were to put $12,000 a year into an index cash reserve account, I'm using a 28% tax bracket, average return of 6.24%, $12,000 going in. Now, there are basically 4 components to this illustration. And you think about it, it goes into the 4 pillars of retirement planning. First is a contribution phase, right? So that's column 1. Column 3 is accumulation phase. Column 4 is distribution phase. Column 5 is legacy phase. So we have a strategy here that has a response to contribution, accumulation, distribution, and legacy. So
just in case, just in case, when we use the term legacy, that's the amount you will leave behind your survivors.
Correct. Right. Yeah. That is the amount, because you know what? Everything is going to result in that. And you want that. Here's the reason why. If you have enough money to last you to the day you die,
right,
you are inevitably going to leave assets behind that were earmarked for you had you lived longer. So you got to have a plan on what's going to happen to that remaining amount of money. So we have to have a response for that. And a lot of people just, sometimes they just don't. And that's a problematic, because then when a person does die, it's unintended consequences. You end up making the IRS one of your primary beneficiaries. But if you notice here, what do you see, Nathan, in column 4? What do you notice about those 2 zeros, right? Those 2 zeros are there. What do they mean? Well, it means there's just no liquidity. There's no liquidity those 2 years. Now the liquidity starts to step in year 3, and then on and on and on and on. So column 4 represents the liquidity to column 3. Column 3 is where you're earning interest based on different stock market indexes that are selected. And in this case here, we use the S&P 500 and the Fidelity Sector 5 index. But now what I'm really interested in is not so much on the accumulation. Now I like to look at an asset and how it generates income. So I started this at age 70, pulling out $36,792. And that income stream lasted all the way to age 100. So how did that happen? How did it last to age 100? Well, for a few reasons. Number one, that 36,000 was tax-free. So you mitigated the risk of higher taxes when you have an asset that the income is tax-free. It doesn't affect you. Okay. All
Sorry,
right.
I'm getting some feedback just on how things are going with the stream. So
Okay.
zoning out a little bit there, but I'm back with you.
Okay.
Everything you said still on track with the goal here today. So good job.
All right. And so when you're looking at this illustration, it just simply means, let's say in year 40, you're 89 years old, you've been taking $36,000 out for all these years, and your account value is $1.3 million, but paying any of this money back, you're not paying the loans back. Because the reason why this is tax-free is because, number one, the income's tax-free because it's a loan, and also two, the withdrawal of the actual contributions you made were after tax. You've already paid taxes on that, so you're not going to pay taxes on it again. So this is tax-free. Now, column 4, I'm sorry, you have $129,000 still left in the account value. That account value is still linked to the same indexes that it was linked when you were accumulating the funds to begin with. In a traditional portfolio, it goes in the other direction. When you're in the distribution phase, you're not still connected to the positions you were during the accumulation phase. That's why you take a lower yield, but your money is safer. With an indexing strategy, your money is always engaged. It's always engaged where it was, even while you were building the account value. That's a huge point, because what this illustration is not showing, it's really showing you a linear return of 6.24% year in, year out, year in, year out, year in, year out. Okay. That's not realistic, because we're just showing you how the mechanics of how it works. But more importantly is, in real life, you're going to have years where the index does 12, where the index does 15, where the index does 6, where the index does 0, where the index does 9. If we were able to show that variance, it would actually create a better outcome. But because we're keeping it to where, we're going to show different assets, we want to keep them all, with a linear return, because we want to just convey the mechanics on how these accounts work. But just letting you know, because I'm going to show you some accounts that are invested directly in the market, that is going to be also a linear return as well. And that's not really going to happen in real life. But the idea is to show you, in a perfect environment, this is what your portfolio is expected to do. With a strategy like MPI, that, let's say at age 80, you got $208,965 in your account value, and the market goes down 20%, you still got $208,965. Your money is not going to go down because of a market negative return from the market. Your market is still collectively earning that interest. Even though you took out that $36,000 that year, it's still within that account, still earning interest, as if that money had not been taken. But because you're not putting that money back, that's how the cash value starts to decrease. But the cash value decreases at a slower pace than it would had the money been in an account where you was withdrawing it. Because when you withdraw it from an account, you're depleting it. Here, you're taking it as a loan. That's a huge difference. Okay. Nathan, how you doing?
I'm doing well. I'm just processing a little bit of feedback.
Oh, okay. I thought you froze up on me.
No. My hand's texting me saying how the audio is and everything, just making sure everything's going well. So,
and Nathan, this is what I wanted to share with you. remember we talk about these contracts. These are, and by the way, the generic name for this is that it's an index cash reserve account that has a life insurance component.
I did have something I wanted to bring up. If you want to scroll back down to the end of
Yes.
that, the prior, when the income stream stops at 100, say that's when you passed away, right? The income stream stopped that year. So that's a $300,000 death benefit going to the surviving beneficiary. So if this was in any other account than an MPI insurance contract, how would that amount be taxed? Say it was in a traditional 401k, 300,000, you were leaving it to your heirs. How would that be imposed on taxes?
That would be taxed at face value. If they were to withdraw the entire account. Now they probably wouldn't do that, but now through the Secure Act, if it's transferred to a non-spousal, 10 years in order to actually take distributions from that account. They have 10 years.
You said you have to wait 10 years upon?
No. The non-spousal heirs, so let's say it's the kids, they have 10 years in order to spend down that account value.
So instead of
they can spend it down in the very last year, or they can spend it down in the 5th year, but they got to spend it all within a 10-year period.
Still imposed a tax though as income.
Yeah. And it's actually worse when you take it as income. You actually end up paying more in taxes.
Mm-hmm.
If the kids were to take it as an income stream, you actually pay more in taxes than if you paid the tax on the entire account value right up front, because you get the taxes out of the way. But, depending on the tax bracket that they're going to be at, $300,000, if it's, it could be $72,000 or more.
Right.
Or a little less.
To say they have a job too, and they're already, they're making 50,000 a year, then they take that on top of it. Now you're just jumping tax brackets too.
Right. And they may not want to take that income, but they're going to be forced to take it sometime within a 10-year period. And they got 10 years to do it. If they don't do it, then they're going to get hit with severe penalties for that. And here's the thing, back in the old days, before the Secure Act came out, they had the stretch IRA. So that was better. You were able to stretch out the IRA for your whole life expectancy. Well, those days are gone. Now you got 10 years. Now, if it's a spouse, that's a little different. The spouse can take ownership of the account, and then she could just use it as an income stream for herself or himself. But the reality is that they still got to pay taxes on that income stream. So no matter what, you don't get passive income. And why are we spending all this time talking about taxes and all that? Because we're sitting in a historically low tax environment. $30 trillion debt we have in this country.
More than that.
55 trillion.
Liabilities.
Oh yeah, it's really more than that. Oh, it's definitely more than that. But just say it was just 30 trillion and that was it. And we're sitting in a low tax environment. If you look at the history of taxes in this country, in the late 80s, in the late 1980s, if you made if you made $30,000 a year, you'd be in a 28% tax bracket. You make $30,000 a year now, you're in a 12% tax bracket. But back then, the debt was what, 940 billion? Now it's 30 trillion. And that doesn't include Social Security and Medicare. So
and inflation hits that even harder.
Yeah. So this, but here's the one thing, looking at this illustration, number one, what if I told you, Nathan, that this illustration is improperly designed? This is an improper design for an index cash reserve account. And you'll get an advisor, you'll get some critic, they'll come in, especially you get these whole life critics. I don't understand these guys.
Oh yeah.
Yeah. They'll look at this. Oh, and they'll look at the cost of insurance, and they'll look at this, that, and this policy, if this doesn't happen or this doesn't work out this way, what? I would look at this illustration and say, this illustration is not properly designed. Because those zeros, first of all, shouldn't be there.
Nope.
This shouldn't be there. If it's designed correctly for maximum efficiency, those zeros should not be there.
You should be earning on year one.
Yeah. But now let's take this improper design and let's apply it to, let's look at what we're looking for here, a tax deductible retirement plan. So that's going to provide, and this would be like your 401k, your IRA, your 403b. We're going to take the tax savings and pretend you're reinvesting it, which doesn't happen in real life, but let's just pretend that. Yeah, never happens, but we're gonna, the idea is to make, and we're gonna show a linear return. So linear return for linear return, all right? So this is saying here, if you got $12,000 you're putting in with a tax deduction, you're in a 24% tax bracket, the total amount you can contribute is $15,789, okay? And I'm showing here, I think here, okay, we're showing a linear from year 1 to 20, and then we're showing 4%, because remember, if you're getting 8.25%, you're in that. But now you go into distribution phase, you're not in that same position. And that's not realistic. You're going to be more in a safe conservative position. So 4% is about the going rate for most bond year period. I know for municipal bonds in the last 20 years, it's done 3.96%. So now you're taking $36,000 a year from that account, and you run out of money at age 87. Where now you see the IUL, it's still going. Now, again, it's not to show that the IUL or these index cash reserve accounts, that they're better. It's just to show you how they react when you are distributing income. These assets over here are designed for distribution. They're not an accumulation play. That's why I never understand why some critics will talk about, they'll criticize a certain asset for that asset was not engineered for that one aspect.
Right.
IULs are not engineered for accumulation. They're more
you know what? I'll argue that too, because as you saw earlier, when you put in the 0 years, we compared the actual market versus the average, and then showed it what it is versus the IUL. The IUL averages 25% because it has that built-in zero floor. How can you argue it's not an accumulation video? Because it averages a higher percent, a substantially higher percent, because of that, the insurance part of it, the zero floor. So how do you argue it is not an accumulation video, a vehicle?
Yeah, you're right. Exactly. Because it has a response for accumulation. I mean, look at this right here. Look in year 20. Look how much you have in the tax deferred retirement plan. You got 536,937. Look how much you have in this IUL, 348,911. Now, most people would think, which account is going to produce the most income? They're going to choose this account value. They're going to choose the 536. When in actuality, it's the 438 that produces the most income. Isn't that interesting? No wonder why this whole thing of financial planning is confusing to people.
Right.
Because how could that be? How could the bigger account run out of money faster? Very simple. It's very simple.
Your fuel economy.
Because of the tax. Because you're going into safer alternatives when you're in the distribution phase. You're actually now going to be more in bonds and fixed investments, while the IUL is still in those indexes.
Yep. Because it has what built into them? Call options.
Market protection insurance. And what is market protection insurance? All market protection insurance is you're hedging against all negative years. 0% floor, and some crediting methods have a cap. Some have a cap maybe of 12. Some don't even have caps.
Right.
Some even allow for more actual index is doing, like the Barclays Trailblazer. What's that? 145 participation.
Yeah.
Yeah. So what I share with clients is this: look, you got this 401k here. This 401k is not engineered for income, but your goal is to build up this account so that you can get income from it. But it's not designed for that. This over here is designed for accumulation, but it really, really shines on the distribution, because the distribution is tax-free.
It'll be
And that's one of the
crazy
beautiful things about these
if
types of contracts.
younger folks took this seriously. You go work for an employer, you do your 401k with match, and me or you or no one's ever going to tell you not to do that. But if you have one of these MPI investment vehicles to act solely for your distribution of wealth at retirement, you can use that whole 401k to live a great lifestyle while you're retired. You can, if you want to take the tax hit on it, you can, say you save up $1 million in the 401k and you got your income secured through an MPI, you can buy a great home with $1 million, or not even, all in the home, but you have more options to live a better life, maybe retire early. It's just about knowing these things at the crucial time and the age. And that's what we're trying to do, is both help the older,
Yeah.
older base that's watching, as well as someone just getting started. Because
Oh man, yeah.
the biggest mistake I made when I was age 18 to 25 is I spent every dollar I made instead of putting some, forward.
Yeah.
For the
Well, the
future.
biggest mistake I made is I was doing what everybody else was doing. I was deferring. I was overfunding my deferred comp,
Mhm.
and I wasn't putting money or a lot, or I shouldn't say I was, but I wasn't putting as much because I was deferring 15% a year into a deferred compensation plan. So I was basically doing what everybody else. I was deferring. And I just had to make a decision one day and say, well, why am I going to keep on deferring? I, I'm a small business owner. I get all these tax deductions. As a matter of fact, I get so many tax deductions that I have to, stop at some point. Too many,
Yeah.
because I'm in my accumulation phase. When you're in the accumulation phase, you got more tax deductions you can take advantage of. So I would rather pay the tax now, where I'm in control of it, and then that way in the future, I don't know what the future is going to bring. So I want to go tax free. You can do a Roth IRA. The problem with a Roth is that it's still a government sponsored plan. You have limitations and restrictions on a Roth IRA. Your money is directly in the market. So you could have losses within that Roth IRA. And the other aspect is you can't touch it till you're 59 and a half. And you also have the 5%, the 5-year rule. So you have those two things you have to satisfy. And get this, Nathan, if you're too successful, you can't even put money into a Roth. If your adjusted gross income right now is $248,000 or more, you're a couple, you file your taxes jointly, you make above $248,000 a year, you cannot even fund a Roth IRA. So
Well,
what are your options?
let me,
Your
I
options are
just thought of
this.
something interesting, because I just did my taxes and it just made me think about this. If you use a Roth, yeah, you can distribute tax free from it. But since you're taking income and you're no longer contributing to the tax pool, you have to pay, I believe, when you do your taxes every year, because you're no longer contributing to the tax pool. Is that correct?
Yeah, there is a certain percentage that you may have to still pay in tax. As far as that specifically, I'm not exactly sure what that would be. I do know that when you put money into a Roth 401k and you're getting a matching contribution from the employer, you will pay contribution from the employer, because the employer was putting in that money pre-tax. The
Right.
employer is not saying, oh, he's got the Roth. Oh, okay, this is after. He's got the other, which is traditional. It's pre-tax across the board, that match. So if you got a Roth 401k, I recommend taking advantage of it, but you will pay taxes on that So yeah, you will.
Most people do not know that a Roth is not
Nobody knows
tax
that.
free.
Yeah. And
Plus,
the
there's
other,
RMDs too.
plus there's RMD. The only way to get away from RMDs when you have a Roth 401k is to transfer it into a traditional Roth IRA. Then you could avoid the RMDs, but you gotta do that. And if you don't got an advisor, then guess what? You're not going to do it. That's the good thing about having an advisor, of some sort, because an advisor is going to tap you on the shoulder if he's doing his job and say, hey, did you rebalance your portfolio? Hey, you got that Roth 401k, you're ready to take a distribution. Let's roll that into a traditional Roth. But if you don't got an advisor to tell you this thing, then I hope you're a reader, I hope
Yeah.
you love to read, and I hope you got plenty of time
Hope
because
you
you're gonna have to
found that
make it your
information
occupation.
too.
Yeah, exactly. So, but look at this, Nathan. The next illustration is the proper way to structure this IUL. This is the way it should have been structured. Notice this: same age, same tax bracket, same yield, $12,000 a year. Let's go to the first one. The first $12,000 a year. But how much does he have in the 10th year? Something popped up in my screen here, and I can't see what that number is there.
103, 245.
Okay. Oh, there it is. Okay, yeah, 103. Okay, so now let's go to the proper one, which is here it is. This one here. 7,000. And the first one over here, you had what?
103.
103, huh? Now, how much do you have in the 15th year? Here, you got 282,000. The improper one in year 15, you got $207,000. So in year 20, you got 348,911, and the right one, you got 476,041. Now, this is what gets me upset here. You get critics, and I read their articles, and I know every single criticism, and I just think it's
I already
stupid.
know where you're going.
It's stupid to discredit any financial tool. It's a dumb thing to do. You guys, advisors out there, you guys are still doing that. Cut it out. It makes you look ridiculous to our industry. It really does, because that's like saying a hammer is better than a screwdriver. I mean, imagine putting a nail in a wall, and I take a screwdriver and I start hammering that nail into the wall, and then the handle part of the screwdriver pops off. And then all of a sudden, I go up to you and I say, Nathan, don't you ever get a screwdriver? And you say, why? I say, because it's a horrible tool. What? Well, what did you use it for? Well, I tell you, I was taking a nail, I was putting it in a wall, and I was taking, all you need is something to hit it with. It just wasn't going in right. So I deem now that this screwdriver is a horrible tool because it makes a horrible hammer. That makes no sense, man. But that's where people are judging different tools from. This tool is bad because this tool over here does this better than. No, man. There's no such thing as a bad tool, only a bad application. You got to use the tool for what the tool
proper
was
way
engineered for.
It's just like, remember when KJ
crazy.
said she was meeting with a local business owner, and he was like, oh yeah, all on board. Yeah, let's get them. I'm just going to talk to my financial advisor. She's like, great. I'll send you the website. And the financial advisor looked at the website and told her, the business owner, not to speak to her again. Like,
Don't.
You don't want to talk to them. I wonder why.
Yeah.
I wonder why.
And to me, that's irresponsible. These advisors out there, if you're not on the other side of safety, of hedging, protecting a client, how could you call yourself a fiduciary?
You're not protecting the client. You're protecting your your income when they do that. You're trying to safeguard the fact that they're not going to find something better and leave your institution. And it's dirty to me.
Yeah. And it's not just like when you show somebody this, it's not like, okay, now I want you to stop doing all of, no. Unless we discover that maybe what you were doing was not efficient. But I'm a big believer. I'm bullish of the markets. And that's why I like MPI so much, because it's an account that you can utilize to make investments and still not lose your cash while you're doing it. I mean, I'm hedging my bets. If I take, like, for example, this year, let's say in the 10th year, I got $145,955 I have liquidity to. If I see an investment opportunity, let's say I take out 45,000, I'm still going to be earning interest on 145,000, even though I took out 45,000, because I'm not pulling money from the account. I'm collateralizing the account, and I don't have to pay the money back. Why? Because I'm collateralized on it initially already. How much am I collateralized? I'm collateralized $291,274 in year 10. So if I take out, 45,000 and I don't pay it back, I got the collateral of 291,000 that can be deducted from that account and it's going to be satisfied when I die, right?
Right.
But if I pay it back, I'm replenishing the account value, but my account value was compounding and growing as if I never, there's no account that can do that. And I say this with a lot of enthusiasm to clients because I was showing these like 2005, but I'm gonna tell you, it wasn't until about 8 years ago that I truly understood the marvel of uninterrupted compound interest. Because I said, wait a minute, hold on a second. I take the money out, I still earn any interest on the money as if I never took the money out. That means if I lose the money into an outside investment, the money that I use is still in the account. So all I got to do is replenish the account, right?
Which
So
it already does on its own.
yeah,
Essentially.
which it could do it on its own, or if I want to repay back the loan, I have the option to do it. Or if I don't want to do it, I don't have to do it. I mean, it's just so much flexibility to have in your portfolio, Like I asked the client, go ahead.
I wanted to just bring up something you said earlier. I'm just thinking, you said you brought up bonds earlier, right? And if you're in a position where you're investing in bonds, you should probably be in an MPI account or an annuity, because the same reason you're looking for being in bonds is you want some yield and security. But
Right.
you're not going to get the same yield as an IUL or an MPI account, same thing, in an annuity, because the annuity or the MPI's got the floor, but you have access to a return rate that's substantially higher than 3.96%.
Right.
So
Like I was saying, municipal bonds. See, you got basically three assets for tax free. You got municipal bonds, Roth IRAs, and cash reserve insurance here. So municipal bonds, the 20-year return was 3.96%. Okay, if you did an indexing strategy with a 12% cap in that same period to the S&P 500, you would have gotten a return actual of 7.29%. And that's with a cap of 12, which we know there's some crediting methods that don't even have caps. So 7.29 tax-free, 3.96 tax-free, and the 3.96 tax-free is considered provisional income on your Social Security. So now, okay, you got tax-free coming from your municipal bond, but you created an unintended considered provisional income. And provisional income is the income that the IRS looks at to determine how much of your Social Security is going to be taxable. So if you make more than $32,000 a year, but less than $44,000 a year, Social Security is going to be taxed up to 50%. If it's more than $44,000 a year, Social Security is going to be taxed up to 85%. The money coming from the insurance contract has no bearing on provisional income. So your Social Security will be tax-free, and your income coming out of your cash reserve insurance account is tax-free. We recommend the index insurance account. The only time I recommend a Roth over an index insurance account is if you don't get approved medically for the index, because you have that insurance component. It has to come along for the ride, because that's what makes the whole thing tax-free. And if you don't get approved that, well, the next best thing is a Roth. But if you can get approved that, then you basically got a Roth with.
Well, what about a fixed index annuity though?
You could do it in a fixed index annuity as a Roth IRA, but you still run into the same constraints of limited amount of contributing, because you can still only contribute up to 7,000 after age 50.
But you do have the market protection though aspect of that, which might come into a more volatile utility when it, depending on the scenario. It all depends on the scenario. If you're able to put 25,000 into a Roth, it's going to outweigh the market protection on the annuity. You see what I'm saying? So just scenario, like you're saying, it's just a scenario.
Yeah, an index annuity is a good play for a Roth IRA if a person doesn't get, they just can't get the IUL, or we keep calling it IUL MPI, and let's just call it MPI.
Is MPI. It's market.
Yeah, IUL is MPI. It's just that we call it MPI because we're focusing more on the account value of what we're done.
It's just like a 401k is an IRA.
Like, for example, this strategy right here, what am I doing? I'm focusing on the account value. So what did I do? All I did was lower the face amount to 144,265. This person over here, they were focusing more on the insurance value. So they did the same amount of premium, but they jacked it up to 524,000. So it depends on what your goal is. If your goal is for more insurance protection, this is a good design in that regard. But if your goal is to build up the highest after-tax income with the lowest amount of internal fees, then we're looking at amplifying the index account. So we lower the cost of insurance to the bare bones minimum that the IRS will allow, and then we maximize the amount of money we're putting into the account. So now when we look at that, let's see here. Okay, so there's this one here. Now I show the 55. Okay, same thing. The money came out, but look at this. When we were looking at the other one, the death benefit was what, 300,000? Here it's 418,000.
On
And
the
you got
on
more
the
income.
incorrect.
Yeah.
Is this
'Cause
on the
over
correct
here-
or the incorrect?
Oh no, this is the correct. See, look, the
Oh.
incorrect on the 100 at age 100 here was 300,000, and that's 36,000. The correct way would be, oh, there we go. More income coming out, 51,000, and then now we have a face value death benefit of 418,254. And here we also got to make mention that this death benefit is also your long-term care money.
Yep.
So if you have long-term care, if that episode comes up,
Yeah, explain
actually
all that
pull
out too, because that's going to be a huge benefit that you wouldn't have in a traditional 401k or IRA too.
correct.
Those living benefits. So explain that out to them real fast, just what that
Real
entails that
quick,
you
yeah.
have built into that.
So let's say at age, I'm just going to pick an age 75. You got 50. You've been withdrawing income of $51,000 from this account. You have a long-term care episode. Now, what is that? What triggers long-term care? It's the same as how Medicaid triggers long-term care or a long-term care
All break your hip.
policy. Yeah, basically, there's 6 activities of daily living: bathing, eating, transferring, using the restroom, continence, or if you suffer a cognitive impairment like Alzheimer's or dementia. If you cannot do 2 of those 6 activities of daily living and your doctor confirms it through a doctor's note, then the insurance company will waive. Well, in this case, we're already taking distribution, so you're not contributing. If this event took place while you were contributing, it will be waived for you. You wouldn't even have to bother contributing because you are on claim. But now if you are taking a distribution age 75, now you have, let's just look at the account. You got 371,045. Now, if you needed long-term care, you're going to be taking from the 407,454. So now you can continue to take your 51,000 tax-free, but now you can take additional from the face value for long-term care. So you can actually combine the two together and actually have more income when you are in a long-term care event. Now, if you take the maximum that you can take out for long-term care, the income that you will get for long-term care will last you 4 years. If you take the maximum, if you don't take the maximum, like for example, let's say the maximum is $50,000 a year for 4 years straight. You took the max. Okay, so you can't take any more because you've taken it from the face amount. If you take out 30,000, well, you're not taking the max, so you could the long-term care event can actually last longer because you're not taking as much. It might last you another 2 more years, like it might last you 6 years instead of 4. Here's the real reality. I had a client one time I showed this and I said 45,000 was coming out for long-term care, and he was like, "Well, that's not enough money." And I said, "I agree, it's not enough money, but let me ask you something. If it doesn't come here, what's it going to come from? It's going to come from your other retirement account, isn't it? It's going to come from your lifestyle money. Your lifestyle is going to be disrupted because you didn't have, I agree, the 45,000 is not a lot. And what you need to do is put more money in to make it more. Well, I can't afford it. Well, okay, I understand. You can't afford it. So better to take half a loaf than no loaf at all. Because if you don't have the 45,000, you're going to have to take it from another source. At least you got 45,000. And now you can maybe take it out additional from another source, but at least you got $45,000 that you're already
Gives you an
there.
option.
Gives you an option. And the great thing about this, this particular play is that there's not a cost for this rider. It comes included
Built
in the
in.
plan itself. It's built into it,
Same
so
with
I
chronic
like that.
or critical illness too.
Critical illness, terminal illness. What I like about it is that from a planning perspective, it takes a lot of the planning out of the equation. To do what an MPI can do, you'd have to have 5 accounts.
Yeah.
With one MPI. I'd have to get 5. You don't have an MPI? Okay, you're gonna have to get 5 different plans. You got to get a life
Bank
insurance, you got to
account,
get long-term
Roth.
care, you got to get a Roth, you got to get a bank account, and you probably got to get a brokerage account there too, because you're going to have some type of call option strategy that you're going to have to do on your own. And you're going to have to buy bonds, and you have to do all that yourself.
It comes to the point. It's like, why wouldn't you pick the product designed to do what the goal is? Retirement with income. It's built for that exact purpose. And they'll tell you, like, oh, but you'll make $200,000, $300,000 more in your 401k, but your 401k is taxed, it has fees,
right,
and it's not designed for that utility, which means
exactly
it's going to run out, or you're going to live off of $20,000, $30,000 a year, which I don't want to do that. You don't want to do that. I don't think anybody wants to do that.
Right. And for the 21st century, we need assets that do more things than just one thing. Rate of return. The 401k has been around for over 40 years. We have the data now to look at. And it has proven to be, from an income perspective, a financial flop. Now, from an accumulation perspective, it's proven to be what it's proven to be. Yeah, it's an accumulation play, no problem. Take the 401k account value, dump it into an annuity, have a guaranteed income stream from that. Boom, done. But you got to have tax-free income on the sideline. Okay, you got it. Now, if you, I don't like life insurance. It's not a popularity contest. I don't believe it. It's not a religion. It's an income play. Okay, you don't got to love it. You just got to like it a little bit more than the IRS. That's all.
Yeah.
And the wealthy have been utilizing it for a long time now.
And I'll say it, and I know you probably will too. If you don't have at least $1 million, you're going to have to put whatever you have into an annuity to get that guaranteed income. You're going to have to.
You have to.
There's no chance. So if you're not going to at least have $1 million, or you do not have $1 million, I mean, and that's on an individual basis. That's per person. If your spouse doesn't also have that, you're going to have one of these set up. And then once you get to 59 and a half, you want to put that into that annuity and let it build up till 65 and get that guaranteed disbursement for life, which a 401k cannot offer that, as we for sure do enough about explaining that.
I know, if we haven't exhausted the point already, I mean, okay, I get it. Okay, good, you got it. Because sometimes
people channel in here. I think we're coming up on an hour, so let's.
Holy cow! Are you serious?
Maybe more. I didn't know when we started. I think
this is let's just finish this last one, because this way we don't have to. This is, so I took the proper design and compared it to the same thing that we were looking at before, tax deferred retirement account here. And as you can see, 8.25% yield, linear all the way through. For the MPI, we did 6.24% and 51. Look at this. Now, the other plan, the $36,000 a year, the tax deferred retirement plan lasted longer. This, by taking more money out, lasted to age 81. So how much income did you get from this retirement plan? You got $630,116. How much did you get from the MPI? $1.5 million, tax-free. Now let's look at this.
Ooh, but look at that though. The contributions was $315,000.
Exactly.
Oof.
Look at this right here, the internal rate of return. This is your internal rate of return after fees. This is what you get. Now, in the IUL, I love this page because think about this for a moment. Absorb this. Traditional financial planning, right? They mostly talk about putting your money in equities and all that, and that's great. That's fine. I dig that. I'm on board. The problem is that the planning from an income perspective is done backwards, because let's look at it from a race. Let's say lap 1, they tell you to sprint. So you sprint lap 1. Lap 2, You're not sprinting. You got a hard run. Lap 3, they're telling you, okay, now you're getting closer to retirement, start jogging. And then lap 4, okay, you're at retirement, now you walk to the finish line. That's backwards, man. It should be the other way around. In the beginning, lap 1, you start with a hard, good, long pace, a good pace. Lap 2, now you increase that pace. Lap 3, now you start running. Lap 4, you sprint to the finish line. Now look at this. The IUL starts off in the beginning with a strong pace, right? Because not all your money is going in the index account. You have that cost of insurance that's coming along for the ride, or else this is not tax-free. But look at the rate of return on that. Year one, what, $1,194% return. I mean, that's a huge return based on premium, but that's if something happens to you, right? So let's
Right.
move on. Now, what do we say? Taking money out at age 70, right? 20 years. Look at the internal rate of return after year 20. 6.15%. So if the yield is 1.24 and you got your after expenses and fees, you're walking away with 6.15. What did this actually cost you? Let me see. That means after 20 years, this thing cost you 9%. It was less than 1%. 0.09 is what this policy cost you in fees. That's covering the commission. That's covering
0.009.
Exactly. Yes, that's right. 0.009. I mean, so we're talking now. When you're judging an investment based on fees, you can't judge the investment based on a small projection because it doesn't give you enough data to judge the merit of the investment. I can only judge the investment based on a 10-year minimum time frame.
And what do they always say about the IULs? The fees drown this thing.
Oh,
We're talking about fees.
The fees.
Let me take 2% of your account value for 60 years, and let's look at what the fee would be that they've taken from your money. Let's just cut it in the middle, 1.5%, the average 1 to 3% that they charge to manage your account. That alone, without the taxes, go look at that number, how much they would make and take from your account. Now we get paid. How do we get paid, Brandon? The insurance company pays us our commission. It doesn't have anything to do with our client. Now, we talk about these other accounts, they're directly making their profit from the earnings of their clients coming out of their earnings.
Right.
If you look at what that would be, it would be a staggering amount they would be making lifetime off of you.
Oh, I mean, I look at it. I got compensated that way. I remember that assets under management, and I saw that it was a long-term thing. But I saw in the long run, that's the best way to get compensated. Whereas with these insurance contracts, it's a one-hit wonder. You're getting the advisor paid. He's out of the equation. He's done. No more. Never to be seen again. Now he's just going to help you manage these accounts, but he's out of the equation. You're not paying an ongoing management. If you were going to pay, the worker is due his wages. If you're going to pay.
Brandon, you, oh no, we're losing him.
Forever. I'm on board with that. If that's what.
Hey, Brandon, we lost the last 20, 30 seconds of still doing it.
You're going to pay a fee. How would you want to pay the fee?
Hey, Brandon, right? We just lost that last 30 seconds of what you just said. You lagged out a little bit there.
Did it really?
Yeah, you froze up.
Should I say it again or no?
Oh, yeah.
I was just talking about the fees. Look, the workers do his wages, okay? If you got a problem with an advisor getting paid, then don't use an advisor. But advisors get paid two different ways. And, there's what they call assets under management. So if he's going to manage the account, naturally, he should be paying to manage your account. But you see, remember, he makes that fee come rain or shine. No matter what, he gets his fee. Hey,
if he loses,
are you on board with that? Hey, I'm on board with that. That's fine. I got on with that. But now with an insurance contract, you gotta remember, it's a passive strategy. The insurance company pays the advisor basically off.
Yep.
He's done, out of the equation. No more, you got to pay this ongoing thing anymore. Now it's just you and the contract that you got. So the advisor is paid off. So let me tell you something, dollar for dollar, it's the compensation is much higher for assets under management than it is for these insurance contracts because it's a one-hit wonder. It's just a one hit, it's a one-time deal, and that's it, it's over with. And it comes from the insurance company. Now you might say, well, it comes in directly from me because yes, there is a surrender charge. And I didn't know we're going to talk about this right now, but there's a surrender charge in there, but the surrender charge has to be in there. Why? Because the insurance companies are contractually guaranteeing all these provisions, not just in your contract, but on millions of other people's contracts. And in order to maintain the integrity of the general account, they have to have a surrender charge for early liquidity. It's like you and I, it's like Nathan, you and I go into business with each other and I'm taking on all this risk. You're taking on no risk. You decide to walk away one day and I wasn't expecting you to walk away. So I got to cover my losses now. So I'm going to give you your cut, but I can't give you 100% of your cut because I forked out a lot of money on this deal and I can't lose money because I got shareholders that I got to be responsible for. In this case, other policyholders. So people say, this sounds too good to be true. How do they do it? Easy, surrender charge. If you walk away too early, you're not going to get 100% of the account value.
Yeah, don't worry about all the we're going to do a whole podcast episode and dissecting the IUL and the MPI and explaining every aspect on it. Yeah, that's a great brief facet, but I don't want to overload with information. I did want to.
So we'll stop it here.
No, we're going to do I think next week we should do that. We'll just dissect how everything and aspect works of this MPI. Get rid of all those. I'm going to ask you all those questions people say. This sounds too good to be true. How do they even make money off of this? You know, all those questions everybody wants to know. But I want to go back to the fees right before we end everything. You have an account for 20 years. Say they just kept a stagnant $1 million in there just for 20 years. How much are they going to make at 1.5% off of that? Of your money?
Off of how much is what? How much account value you talking about?
The charge is 1.5%, and we'll just say an account value of a flat $1 million for 20 years. How much of your money are they going to make in 20 years? How much are they going to take from your account value?
You're talking about $1 million. I mean, and we're looking at, I don't know, 1.5. What? Yeah, over 11,000, 15,000 is what they're going to pull out. I mean, is it going to charge
over 20 years?
Yeah, over 20 years. Right. Exactly.
So you have to multiply that by 20, don't you? Because that's a yearly charge.
That's right. Oh, yeah, that's right. The yearly charge. That's right. I was just focused on the yearly. But yeah, you're right. Multiply by 20.
$100,000 of your money at a 1.5%, which is the middle of the road. That comes out of your money. Because I had a guy tell me that, that the other day on Facebook or whatever it was, like, oh, you just keep getting paid off this stuff. Like, no, I get paid by the insurance company one time. However, your asset manager is going to make, and you talk about, this is just 20 years. If you have a 401k, you have it for 60, typically, age 20 to age 80.
Right.
Can you imagine how much higher that is? And they want to come after us saying our fees and everything are bankrupting them and the fees are too high. Oh, give me a break.
It's what I call it's a hominem attack. When you can't judge the asset anymore, you got to judge the person who's recommending it. And then so you go off, the compensation, they're doing it for the, let me tell you something, they're doing it for the, look, bottom line is,
so are you.
Compensation is compensation, but I'll tell you the size of the equation on the securities end of it, on the insurance end of it. I'll tell you right now, the assets under management is compensation wise is a better play for the advisors. It's a much better play. That's why they don't want this, because that's not assets under management.
They want to take away from their assets under management.
Exactly. They want that. It's a residual income. And hey, I get it. It's not a bad thing. It's not a good thing. It's just that how can you knock compensation over compensation? How do you do that? How do you get past that?
It's your last line before
Yeah,
defeat
it's yeah. Oh, I got to get them somehow. Oh, it's the commission, dude. Come on, man. Let's
he
get
just wants your
realistic.
commission. Like, yeah, so do you. It's how we both make our living. Grow up.
Well, yeah, we got to practice the same strategies that we're recommending. So we are inundated with this information. You know how much studying it takes to gather all this data in your head. It has to be. So yeah, So I just feel, hey, if it's right for the client, it's the right thing.
That's what matters, is if it's right for the client.
Right.
So, all right, buddy. Any closing arguments or any closing statements you want to make?
No, I think that, we hit it. Just, look at your strategy from risk management. Just look at the risk: market risk, tax risk, inflationary risk, longevity risk. Look at those 4 risks and see and question your current strategy. See if you have a response for all 4 of those risks. And that's a good starting point.
I couldn't have put it better myself.
Yeah.
I think next week, guys, we're going to close things up here next week. Brandon, I'm going to put you through the ringer. I'm going to be your client. And I'm going to ask all those questions clients do. And you're going to present me an IUL illustration, and we'll do a little kind of role play so they can kind of see, how that interaction usually goes. Not as far as like, we usually do it for training, but this is to answer all those questions that we get, and anybody watching is going to have about that is, how can they do this? So we're going to answer all those questions, show them what a properly structured IUL and MPI plan would do for a 28-year-old guy up until retirement with distribution. We'll just say $500 a month is what I'm going to contribute. Say I make $2,000 a month, 20% of my income, like Dave Ramsey says, should go into investments. Or maybe that's 25, but we'll just roll with it. $500 a month. We're going to show them that. I'm going to ask all those questions. We're going to answer them together. Everything possibly, the good, bad, and the ugly that you want to know about this account, we're going to tell you exactly the gears and the cogs behind it, how it works. So when it comes to it, because there's the main thing we deal is people got the shackles on their ankles with their 401 because everybody feels safe, like we talked about earlier. Feels safe because it's been around for so long. Everybody's
the herd mentality. It's the herd mentality. Yeah.
So we'll go over all that, and I think it'll be fun. I think
we'll have a good time with it. Yeah, it's good. It's informative, and people need to know that, hey, know your risks, and then just go from there. And then if you have any questions on like that, just give Nathan and I a shout out, and we'll try to help you out in any which way we can.
We're not just talking about MPI on this. We have lots of great new investment accounts that might be very advantageous to certain people. Like we talked.
Oh yeah, that's gonna be
another associate of ours, the 5-year one.
Yeah, there's going to be some good stuff. Alternative investments. We'll get into all that stuff too. So, that's going to be exciting to bring that up. There's a whole world out there. So you just,
and you're only going to
got to be willing to learn. You just got to be willing to be open to it. Cool.
Absolutely. All right, brother.
Awesome. So, all right, my man.
Let's wrap this thing up. And
let's do it.
Is the 331 and March 31st edition of the Beyond Wall Street podcast.
Awesome.
With a little bit of technical analysis in between of the stream quality, but we got her done. Next week, review of the IUL, everything that makes it work, and we hope to see you guys then. I am your host, Nathan Bowers, here with Brandon Nieves.
Later on.
Signing off.
Okay.
Bye, everybody.
Bye. Later.